Curious. Here's a strange contradiction about wealth. A genius with multiple degrees can memorize everything about investing and still end up bankrupt. Meanwhile, someone with a very ordinary education, working a standard job, can quietly retire with millions. We are heavily conditioned to believe that wealth is a mathematical equation. We assume it requires complex spreadsheets, analyzing stock charts, and finding exactly the right formula. But when our own savings are actually on the line, we rarely behave like calculators. We panic when markets drop. We become greedy when we see neighbors buying new cars. We abandon our spreadsheets and make financial decisions based on emotion. The difference between the bankrupt genius and the wealthy everyday worker is not the size of their intellect. Financial success is a measure of your behavior. It is easy to look at how someone else spends or saves and think they are making mistakes. But people are rarely being irrational. They are simply operating on different sets of data. Imagine a person who grew up during a terrifying economic depression. Their family lost their savings, and they learned to hoard every penny. Now, imagine someone raised during a booming economic expansion, watching people take huge risks and double their money. Both of those people can look at the exact same investment opportunity today and reach completely different conclusions. Every single financial decision is filtered through personal history. You cannot accurately judge someone's financial logic without understanding the psychological background that shaped it. When we stretch these behavioral patterns across a human lifespan, the traditional rules of financial math start to break down. There is a distinct difference between getting rich and staying rich. Accumulating money usually requires taking big risks and leaping at new opportunities. Keeping that money requires the exact opposite. It requires a mindset of survival. If you take a massive risk and lose your entire portfolio, the math is final. You are wiped out. You no longer have the capital to participate in any future opportunities. This instinct for survival directly conflicts with our natural human impatience. We constantly look for ways to double our money overnight, and that desire for immediate returns actively interrupts the greatest wealth-building mechanism available. This chart shows an exponential compounding curve. Compounding is the quiet accumulation of reasonable returns, repeated year after year. But in the final quadrant, the curve spikes vertically. The most massive gains arrive at the very end, rewarding extreme patience. Survival acts as the mandatory prerequisite that gives compounding the decades of unbroken time it needs to work. We naturally judge success by what we can see. We look at luxury cars and massive houses and designer clothes, and we assume we are looking at wealth. But those visible items only tell you that someone had the income to buy them. Being rich is spending current income to show off. Wealth is the invisible money that has not been spent. Building that invisible foundation requires wrestling with a difficult psychological concept, defining what is enough. Numbers are infinite. You can always add a zero. If your definition of financial success is based on earning more than your neighbor or reaching the next income bracket, you will never actually cross the finish line. The moment you step onto a higher rung, the standard moves upward again. Without setting an absolute limit of enough, that endless chase for more will eventually push you to take reckless risks, and those risks will destroy the very foundation of invisible wealth you spent years building. If the ultimate goal is not to buy visible status items or to constantly chase a higher income bracket, what are we actually accumulating this money for? The highest possible return on investment you can get is using your money to buy control over your own time. This means having the ability to walk away from a toxic job without panicking about rent. It means rejecting bad opportunities, deciding your Tuesday mornings, and prioritizing your family. True financial freedom occurs when you transition from money dictating your choices to money protecting your autonomy. You can design an investment portfolio that mathematically produces the highest possible returns. But if that plan causes you to panic and sell everything during a market crash, it is a failed strategy. The best financial plan is the one that lets you sleep peacefully at night during periods of market uncertainty. Mastering your finances is not a test of your intelligence or your ability to predict the future. It is a lifelong game of managing your behavior. Building true wealth depends on shifting your focus from the data on the calculator to the person looking back in the mirror.